Hello everyone, welcome back to Rajeshwari's Commerce and Management Study Hub. I am Rajeshwari here. In the previous video, we have understood the concept of cash flow statement and the format pro forma of the cash flow statement. If you are not watched that video, kindly watch that video to get conceptually clarity. You should never ever by head the format, you need to understand. Today, let us solve the problems, practical problems on the cash flow statement. Here we have a question. The balance sheet of X Limited as on 31st March 2021 and 31st March 2022 were as follows. Here, the 2 years data is given. While explaining the concept of cash flow statement, meaning of cash flow statement, I have told. Flow means there is a changes. The changes in the cash we are recording. So, and or we are recording the previous base year data or the current year data. We are recording the changes in that particular concerned asset and the liabilities. Land and building 80,000, 1,20,000. Plant and machinery 5 lakh, 8 lakh. Stock 1,75,000. See, here you need to observe stock, sundry debtor, prepaid expenses, cash at bank. Cash at bank, we will opening cash we are showing at the end of the net cash. We are adding with net cash, then we will get your final answer 18,000. Our answer should come 18,000. This is our answer, final answer, the closing balance. So here you need to understand the comparison between the current assets, whether it is increase or decrease. Because increase in current assets, what we are doing, we are minusing, because that reduces the cash. Here we are analyzing what cash it is coming in the hand, that we are taking into consideration. Okay, that is why. And liabilities and capital, share capital is given 5 lakh, 7 lakh. Profit and loss account is given because our cash from operating activity starts from the profit and loss account. So 1 lakh, 1,60,000. General reserve 50,000, 70,000. Sundry creditors 1,63,000, 2 lakh. Bills payable 30,000, 40,000. Outstanding expenses 7,000, 5,000. See, land and building is what? It is a investment. Investing activities. Under investing activities you are showing. Plant and machinery. You are showing under which? You are showing under investing activity. Stock, debtors, prepaid expenses, cash at bank, operating profit. Profit before working capital changes. Under that you are showing. Share capital, it is a financing. Profit and loss account, you are showing under operating activity. General reserve, operating activities. Sundry creditor, bills payable. Outstanding expenses are current liabilities. Working capital changes, under that we are showing. And we have adjustment to this question. So let us see the adjustments. The adjustments are, the first adjustment says 50,000 depreciation has been charged to plant and machinery during the year 2022. During the year 2022, they have charged the 50,000 depreciation. A piece of machinery was sold for 8,000 during 2022. It had a cost of 12,000. Depreciation of rupees 7,000 has been provided on it. Prepare a cash flow statement from the above details. So we need to prepare the cash flow statement. Let us prepare the cash flow statement. First we are starting with cash from operating activities. Operating activities. Cash from operating activity, first we are taking the profit into consideration. Profit during the year. During the year. Here what you are considering? The changes. The previous year and the current year, your comparison you are doing. The previous year, current year, the profit is 1,60,000 and the base year it is 1 lakh. The difference is 60,000. This is your profit during the year. Now you are adding all non-cash expenses. that is depreciation is given. Only one non-cash expenses we have, that is depreciation. Depreciation on machinery. Depreciation on machinery is 50,000. General reserve. General reserve. General reserve is 70,000, 50,000. What is the difference? 20,000. This is general reserve. Now, this is cash from operating activity before working capital changes. Working capital changes. 60 plus 50, 1 lakh 10,000, 1 lakh 30,000. 1 lakh 30,000. Now let us see the changes. First we will take add. What you need to add? You have to add any decrease in current asset. Decrease in current asset. Decrease in current asset, we have stock. There is a decrease in stock. What was the stock value which has been given? The stock value was, it is 1 lakh and 75,000. So what is the decreased value? Decreased value is 25,000. Then decrease in prepaid expenses. Prepaid expenses. It is also current asset, 2,000. Then increase in current liability we are recording. Increase in creditors. Increase in creditors. Increase in creditors is 37,000. Then income, bills payable. Increase in bills payable. Bills payable, it is current liability increase. Bills payable, you are going to receive this amount. We have concept called prudence concept. Here you need to consider the expenses first, ignore the incomes which you are going to receive later. Then that concept we are deducting the current assets which is decreased and which is increased, and decreased we are adding. Increase in creditors, increase in bills payable is 10,000. The total is 2 lakh 4,000. 2 lakh 4,000. Now less we have profit on sale, because the cost which is during the year 2000, which was sold for 8,000, it had a cost of 12,000. Depreciation charged 7,000. There is a profit is there, that we have to prepare the plant and machinery account. Let us prepare ledger account, plant and machinery account. For all the assets, opening balance comes under debit side. To balance brought down. What is the opening balance? 5 lakh. 5 lakh. Then we have sold by cash account, that is sale of machinery for 8,000 we have sold, and depreciation has been charged on the machinery. Depreciation account, it is 50,000. Then closing balance we have by balance carry down. Closing balance of 8 lakh. Plant and machinery is 8 lakh. Now we have a profit on sale. Profit on sale, that is 4,000. 4,000 is the profit on sale. To cash, this is the, when debit side, credit side exceeds the debit, then it is considered as a purchase. Balancing figure, total here it is 8,58,000. 8,58,000. 3,54,000 is the balancing figure that will be considered as a purchases balancing figure. If in case debit exceeds the credit, then here we are taking it as a sales. The balancing figure will be considered as a sales. This you need to remember. Now this profit on sale, non-cash income, that we have to minus gain on sale of machinery 4,000, increase in debtors, 10,000, increase in bills payable 2,000. Now understood? Gain on sale of machinery, increase in debtors, increase in bills payable. This we are minusing. From 2,04,000, if you minus 16,000, you will get 1,88,000. 1,88,000 is the cash from 1,88,000. Cash from operating activity. Cash from operating activity. The next is, second is cash from investing activity. Investing activity means purchase and sales. We are going to consider the in the investment activity. Investment, what you are doing, investment from the cash is going out for the investments. Here, sale of machinery. When you sell any machinery, cash is coming in or going out. So coming in, so that should be added 8,000. Then we have purchase of machinery. Purchase of machinery, that is in ledger account we have prepared now 3,54,000. 3,54,000 that we have to minus. Then we have purchase of land and building 40,000. 3 lakh minus 3,86,000. Then this is the cash flow from investing activity. Then we have at the end financing activity. Cash flow from financing activity. financing activity, that is issue of shares. Issue of shares. Issue of shares is, how many shares issued? 2 lakh. 2 lakh. Cash flow from financing activity. We don't have any debentures cash flow from financing activity. 2 lakh. Now net cash increase. Net cash increase 2000. Net cash increase is 2000. If you add cash balance opening 16,000, then your closing balance is cash balance at the end 18,000. That tallied, right? Our problem is correct. See here, what is the cash at the end? 18,000. Our answer is 18,000. I hope you all understood. Thank you for watching. Have a great day.